unexpected. It just came from Amazon the other day. I got this new keyboard and new mouse. Okay. They're all the color fluffy ones that are nice to look at. The problem is I didn't read the details enough. It only comes with one of the single USB plug for the 2 items. So I can't use the keyboard without the mouse. I can use the mouse without the keyboard. And they're both wireless, but they're also the ones that you have to plug in and charge like your cell phone. And they're constantly running down and running out. I don't know. They're ridiculous. I mean, I'm going to change back eventually to my old keyboard. Fortunately, I had a different mouse here and I just switched over. So we're fine at the moment. Sorry about that, though. So chart patterns fall into a field that we know as technical analysis. Although I'm going to take the word technical analysis and throw it in the trash. And we're going to use the word chart analysis. Because technically, technical analysis for us is everything and anything we do on a chart. So charting refers to technical analysis that is performed through careful inspection of asset prices, price data for identification of well-known patterns that emerge in share prices. For example, head and shoulders, channels, triangles, and wedges. And there's a lot more. There's a cup and saucer. I saw a new one the other day that somebody came up with. I even forget what it was called. It was called the curve something or another. But chart patterns are well documented in technical analysis literature and are based on the psychological phenomena that occur between the buyers and sellers of financial instruments in liquid markets. Pattern formations do not form a trading system. Keep that in mind. They are part of a understanding or interpretation of price, but they rather provide an indication of future trends of an asset as the price breaks key psychological barriers in the form of support and resistance. Now, the patterns are named after the shapes that they make. So let me pop up a chart here for you because I have them all on a nice chart ready for you guys. Okay, hold on one second. Okay, so we have things like the head and shoulders pattern, double tops, double bottoms, triple tops, triple bottoms, falling wedge, rising wedges, flags, pennants, consolidations. All of it sounds interesting. Now, you got to remember, different things work or apply differently to different, not assets, but types of trading. Okay. Since we are here with Alvexo tonight, and Alvexo is a CFD provider, and we're looking at short-term trades. Okay. Like I said, a CFD can be kept open for as long as you want. But we're looking at very fast-moving markets, and we're looking at very short period charts. Okay. And most of the chart patterns don't work well in our type of trading. First of all, they take too long to form. And trading in short-term markets or trading on short-term charts is also very chaotic. And it's very hard to see these patterns develop and take the time to develop. And so they don't really mean a great deal to us. Now, as we see here on this chart, we have all kinds of things that will occur in a normal moving market in an average day. Okay. Now, you could learn all of these. You could memorize all these, and you could learn exactly what to do or what the experts tell you to do when each one of these develops on your charts. And you could spend your days staring at charts, getting no information, making no trades, and memorizing and trying to do things. It's almost like learning and memorizing pattern recognition with Japanese candlesticks. You could memorize all 72 major patterns. You could look for them day and night. You could know exactly what the book tells you to do when you see 3 black crows or 3 white soldiers. But it just doesn't help your trading. You just spend hours looking for this. What you need to understand is what we can see on our charts, what we can see in our time frame, what would work well for us, and what would bring us success. Now, the most common pattern happens quite often, and I've also lumped them all together. See, this is called a bull pennant. Okay. What do I call this? It's a triangle. This is called an ascending wedge. Where I come from is called a triangle. This is called a descending wedge. I call it a triangle. This is a bear pennant. I call it a triangle. Okay. This is an expanding wedge. I call it a triangle. What did we learn when we were in grade school? A triangle consists of a base and 2 sides that are converging on each other. Okay. A cup and handle could work in a slow-paced market, but God knows I never even recognize them on my charts. Sometimes, if somebody shows me a chart that's got inverted head and shoulders or a regular head and shoulders, I'll see it when they show it to me, but they take so long to develop. The markets pass by. They are kind of reliable. Now, the fact is, each one of these patterns has somebody somewhere that's written a set of explanations on what you should do every time you see this pattern. But I've done the work, okay, and come to realize, and so have a lot of people in our industry, that a triangle is a triangle is a triangle. And memorizing what it's supposed to do, whether it's a symmetrical, an ascending, a descending. The fact is, there's nothing you can do until price tells you what's happening. So the only thing you can do is wait for the breakout of the triangle. Okay. Now, the old textbooks want to tell us that when you see a descending triangle, it's most likely going to break downward. You see a symmetrical triangle, it's going to most likely break down. When you see an ascending triangle, it's going to be a continuation of the trend. Well, to be honest with you, it's BS. Okay. The only thing that holds true is you don't know what's going to happen until price breaks out of that triangle. Now, we do know that as the upper support and the lower resistance, or the 2 lines, converge on each other towards the apex, it's forming a whole bunch of tension in this pattern. And sooner or later, it's going to break out of that pattern. And the fact is, since we're dealing in fast-paced markets, we want to be able to see these, know these, and recognize them and react to them quickly. So triangles appear on our charts quite often. Now, here we have a very long-term triangle that developed. But the fact is, that took months to develop. It doesn't help us in our style of trading. Now, it does help us with some general environmental information. Okay. Environmental information is, if I'm going to look at an asset just to consider it, I want to know what is the overall environment that we're trading in. It might be right now, today, in the last 3 days, in an uptrend, but it could be in a longer term downtrend. So I know where the pressure is. Okay. You know, like the euro, I think I noticed it. Well, I've got a euro chart up here. The euro soared today, euro dollar. Okay. And that's quite fine. And we would see the euro being in an uptrend, a very nice little uptrend, actually. Now, I'm not talking about trading the euro. I haven't done any research. Okay, this is my standard teaching chart. Happens to be that this is the way the euro is going today. But it came off of a very strong downtrend. And if we looked at it in a longer period of time, we would know that the euro has been significantly trading in, well, a downward motion for a while. But look at this. If we look back all the way to November, we see the euro is actually moving towards an uptrend. So we know where the pressure is. The pressure, the longer term pressure, is pushing the euro up. So if we saw a longer term triangle develop, like we see here, and we saw a pattern, okay, we would understand what some of the pressures. But the fact is, we see price moving into the center of this apex of the triangle. We can't make any decision till it breaks out. Now, here it broke above, here it broke above, but it didn't stay above. It didn't close above, or it didn't have a confirmation. Now, here, what do we get? We get a nice little short-term triangle right here that gave us a lot of information. But look, it didn't break upward like the gurus or the book said it was. It broke out downward. So we don't really care what the book tells us. We care what price is telling us. So chart patterns can be very helpful to us if we know how to value them, how to find them, and how to add them into our trading decisions. So if we learn how to recognize a triangle, because trading isn't a clean, simple thing. Okay. Trading, looking for a triangle this way is pretty simple. Looking for a triangle in all of that mess out there, which is the reality of trading, is really difficult. Although today we have computers and we have these incredibly great HTML charts and Java charts. And I'm not a technical kind of guy, and I don't know the programming that goes with it. But now we can even go, I'm sorry, we can even go, why is it giving that for an audience view? Oh, what the, hold on a second, I pushed the wrong button here. And it still won't go away. I'm sorry, guys, there seems to be something wrong entirely here. There we go. Okay. Now I lost my track of thought. Okay. There is today help for us. Let me get back to my Euro US dollar chart. Let's go back to my 1 hour chart. And the computers are getting so smart that they're going to replace us. I mean, sooner or later, when ChatGPT gets updated information to 2023, it's going to be able to make all of our decisions for us on its own. You know, I run a couple YouTube sites, and I use ChatGPT often to write articles or postings for my sites because you can upload information and tell it to use that information. So today I asked it to give me a satirical, humorous article on 10 of the most outrageous trading strategies imaginable, and I actually made them up and did this. I mean, I was amazed. Okay, and I published it. It's on my blog somewhere. Okay. But today, it used to be with Japanese candlesticks, they were as difficult as I said. I trade from bullish engulfing and bearish engulfing. I teach a class on dojis. But today, our computers are so good that we can actually just click on candlestick patterns and ask our computer, I'm sorry, they keep changing everything around here on. TradingView keeps changing everything. Almost, they're at the point where they're changing things daily. I have no idea where to find things anymore. Okay. Okay, well, you can tell it simply to show you the candlestick patterns on your charts, and it will do exactly that. And it'll find the bearish engulfing pattern, the bullish engulfing pattern, and drop them right on my charts. I don't have to look for them anymore. It'll look up any pattern I want and give me the choices. Well, today, now let's see if I can find it again. They've also added a script that will give you your chart patterns directly on your computer without even looking them up. But again, they've moved it somewhere else. I have no idea where they've moved it to. But your computer will now find every chart pattern you want. Here we go. So if I want a bearish flag, I can just click on here and list it in my favorites and put it right on my chart. So if I want to see a double top, I want to see a bearish pennant, I just click on it and it will put it right up on my screen. Oh, I see what they did. They moved them all over and now want to charge you more money to actually access. Okay. But you have the same ability under the charts from Alvexo. Okay. And sooner or later, they'll be able to do everything for you. So today, you don't have to go looking for the patterns any longer. But there are certain patterns that we should be aware of because they appear quite often in our chart. And those are triangles. And they really are helpful because now all patterns have a set of rules. Whether you should go long, go short when you see them, I say that's all a mess. But the standard interpretation of all patterns, besides which direction they should go, is that the width of the pattern can also help you determine at the breakout what the momentum should carry that price to. So at the breakout, if you take the width of the actual triangle or the width of the pattern you're looking at and drop it on your charts, you will then be able to calculate your target price. Now, this also goes for every one of these patterns has a formula. Okay. And like the head and shoulders, it's half the neck plus the head, and it will give you the breakout point. That helps you. The patterns will also help you because for every trade you're going to initiate or every trade you're going to think about, you need to be able to set your risk reward ratio. So you have to figure out where to put your target. You have to figure out where you're going to put your stop loss. Now, patterns are great at helping you set stop losses because you can see how the price and the pattern moved within that particular pattern. And then you can determine your stop loss. So here, the standard formula for head and shoulders is right here. You can see it on. So when it comes out of the pattern, when it breaks the neckline, we would then sell. We would use the height of the shoulder to the head to set our target price for when it gets its breakout. And it's just the reverse on the inverse head and shoulders. Okay. Now we have lots of patterns that are very simplistic patterns. We have like double tops and double bottoms. Okay. I don't even recommend to anybody wasting their time trying to find them and trying to see them, or even incorporating them in your trading, only because today double tops and double bottoms appear continuously in our trading. It's like trying to use a doji in candlesticks. They appear so often on your charts that they just don't really tell you anything. Okay. Because a double top is basically price moving up, hitting a resistance level, falling back down, hitting a support level, going back up to resistance level. Well, we can better use our support and resistance levels than looking for a pattern to say, oh, we're going to call that a double top or a double bottom. Now, once we get to triple, okay, it's the same thing with price. Again, trading within a range, running up and hitting the support, the resistance, falling back and going to support, going back and forth, back and forth. Okay, now that's a great trade for support and resistance trading, but you don't need to look for a pattern. But with triangles and all chart patterns, though, is the quality of the trend. Okay. When a pattern develops in a well-developed trend, that pattern is more reliable than when it develops in a weak, unqualified trend. Okay. Here you have two sets of price movement. This is a pretty price movement. Okay. Push, ease, higher high, higher low, higher high. Okay. When you get the breakout, when you get the pattern and you get the breakout, it's going to be a lot more reliable than when you get, just because price is higher doesn't mean it was in an uptrend. It's just higher. So when you get a breakout of a messy movement, okay, it has less reliability. So keep that in mind, because we're always looking for high probability trades, which means we are always looking for trades that fit everything the best. So again, what we're looking for ultimately is the breakout. So the pattern is said to have broken out once it has crossed either the support or the resistance line. If the pattern broke out in the same direction of the preceding trend, it's called a continuation pattern. If the breakout was in the opposite direction, it's called a reversal pattern. For example, a pattern described as a bullish reversal triangle would mean that's a bullish signal that is the breakout was through the resistance line upward. Who cares? Do you care? I don't care. But you want to put all this in your head, you can put it in there. But what you're looking for is the strong breakout signal. You're looking for a high qualified trend movement with a high qualified pattern, and you're looking for a significant breakout. Now, I have a rule of thumb, and if you take my class on triangles, it's how you determine the breakout, how you confirm the breakout, and where you would enter a trade in the breakout. Because just because price broke out doesn't mean it's going to continue that way. You get lots of falls. So you would wait for a confirmation candle to tell you price might remain out. And then on the third candle, you would open your trade in the direction of movement based on the close of the breakout candle. Okay. You would set your stop loss at the most recent swing low, and you set your target price at the width of the base of the triangle. And then you do your calculations using that for your risk management determination. But you always have to wake out for the breakout. But this is the formulas I was telling you about. So see here with a falling wedge, you would set your target equal to the base, the stop loss below, the resistance line below, the entry point after the breakout point when it breaks out upward. Every one of them has a set of formulas. Now, these formulas are only used to help you set your target price and where you need to put your stop loss so that you can calculate your risk management. Okay? But there's simple ways to help you see what price is trying to tell you. But you can never make a trade, and you could never set up a trade hoping for a breakout. You have to get the break of the pattern and some type of confirmation that price is broken out of that triangle and going to stay in that direction. And there's all types of ways you can do it. You can use Fibonacci levels, support and resistance level. You can use, my standard is breakout, confirmation candle, and the last kicker is volume. Okay, if you look at volume, it will help support your decision. But you also have to be able to recognize the difference between retracements and reversals, because retracements happen all the time. So the common technical indicators that are used to monitor retracements are Fibonacci retracements, trend levels, support and resistance, or pivot points. But you just have to remember, when you get that breakout, you have to be able to understand what cycle you're in, where you sit in that movement of the trend. Okay. And I don't want to predict whether I'm going to get a continuation pattern or a reversal pattern. I only want to consider, when I get a breakout, what I should be doing, and is it a true breakout? Because there are both bullish and bearish continuation patterns. Any given pattern is not considered complete till price is broken out of the pattern and resume the preceding trend. See, that's where the falsehood is. Price has no reason that it has to break out and follow the preceding trend. There are plenty of false breakouts and apparent patterns that form but still lead to a trend reversal. Also, despite their widespread appearance, continuation patterns are still somewhat subjective. To combat possible false patterns, traders use other technical indicators to determine. But there's also way too many false signals. So the first thing you have to do is qualify your breakout to understand that you have a true breakout. And on that note, I'm going to say goodnight to you. Sorry I messed up with the mouse, and sorry I messed up with the screen for a second there. I guess tonight's just not one of my better teaching nights, but I hope you learned something. I hope I gave you some point of view. I hope I gave you some framework. But if you're interested in patterns, I would come to my class on trading triangles, because I love triangles. And that way we don't have to talk about all these other patterns. We can simply talk about the triangle trading strategies. So thank you very much. Thank you for being part of Elvexo, and have a great trading night. Bye now.